Five stocks I'm buying now, April 2023 edition. Welcome in, folks. Thanks for joining me for this one here today. I'm going to take you into actually four stocks I'm planning on buying in the month of April 2023 here, and one ETF specifically. And a few of these stocks are growth stocks. A few of them are more in the value dividend category. And the ETF is a little bit more of a hedge that I'm looking at here. And so, yeah, we'll get into this a little bit, give you little details around this so you can kind of see what I'm up to in the market, and obviously kind of get into my thought process around some of these positions and share a little bit of this with you guys. As always, I appreciate you joining me. Thanks for being here. Thanks for smashing the thumbs up button. Thanks for being subscribed to the channel. I appreciate everybody. If you're looking to apply for my private stock group, my private wealth group, and learn exactly how I analyze companies, exactly what I look for in companies, go ahead and check out the pinned comment down there. That will be to apply to that. Once you hit six figures in the market or more, we'll send you one of these diamond awards in the mail. And then once you hit seven figures plus, we'll send you one of these bad boys right here. So yeah, I appreciate everybody joining me as always. And also, if you're looking to keep up with all the moves I'm making in the market, check out my Patreon. That will be in the description area. Okay. Alrighty, first stock up here is Amazon, Amazon stock. This is my number one focus as far as let's call it a mega cap stock this year, specifically in 2023. Tremendous opportunity, in my opinion, this year to add to Amazon. And so this is kind of my year I'm looking at, like, this is the perfect scenario, essentially, okay? So Amazon, obviously, you guys know their e-commerce platform. You should know Amazon Web Services, which basically almost runs the whole world now at this point in time. It's absolutely incredible. The backbone of how many companies run on Amazon Web Services is phenomenal. They also own businesses like Whole Foods, Twitch, many other various businesses as well, okay? And the interesting thing about Amazon is this stock price is all the way back to where it was in 2018, actually now. 2018. It's incredible, right? Trading at a price to sales ratio that's recently the cheapest we've ever seen it, which is incredible. Trading at a price to book recently, that's the cheapest we've ever seen it in regards to this company. Now, check this out, okay? If you want to see the ultimate just perfection in terms of revenue growth over the years, that is Amazon. I mean, you look at this company over the years, right? 2016, $135 billion in revenue, then $177 billion in revenue, $232 billion in revenue, $280 billion in revenue, $386 billion in revenue, $469 billion in revenue. This past year, almost $14 billion of revenue. This company is scaling to $1 trillion of revenue over this decade, essentially, which is going to be very, very exciting for this company. And when it comes to Amazon, they've also been growing their gross profit in an immense way, right? From about $47 billion in 2016 to this past year, $225 billion in gross profit for this company. So it's a phenomenal revenue growth company and a gross profit growth company, okay? Now, this is very important, because it's not just about the top line and also the gross profit. It's also about what are they bringing home after everything, okay? Net income. And look at the way this company has scaled net income over the past number of years. 2016, $2.3 billion of net income. 2021, they did $33 billion of net income. Now, this past year, their net income got screwed up for many various reasons. And I mean, it's a whole host of them. Rivian hurt them very bad. They have a huge investment in a company named Rivian, which you might know for the electric truck. And because the stock price went down so much, it pulled down their net income. On top of that, they got hit with inflation pressures. They had layoffs. They had like a million different things that killed their net income this year. It's a one-off event, in my opinion, and they will be back to normal starting actually in the back half of 2023 and moving in the future here. And one of the great things as far as the bottom line goes is they're right sizing their company right now. They added way too many employees, bottom line, okay? And so they already announced a couple months ago they're going to cut about 18,000 jobs, and these aren't really like the traditional just like warehouse jobs you're thinking of, like the low paid. These are mostly like corporate office type jobs. A lot of these employees, I'm sure, make 100K, 200K a year type jobs, right? Plus all the other compensation that goes around that. It's quite immense. And then they're expected to do another 9,000 more workers in addition to the earlier cuts. So right sizing the company now at this point in time and getting them very focused on that bottom line, right? And getting that, Andy Jassy, I think, is going to do an amazing job running this business over this next number of years and getting that net income to the place it should be for this company. Now, when it comes to Amazon, it's kind of a wild card on what they're going to put up over this next couple of years for EPS. You know, next year, analysts on average, 43 analysts cover stock. They have 252 as being the average. I don't think analysts really have any idea what Amazon could do in 2024 specifically, which for a stock like Amazon, everybody's always looking to the future. So we're really already focused on 2024 now at this point in time for a company like Amazon, right? But the interesting thing is you have analysts even on the upside of 354. I think they could definitely do anywhere from $3 to $4 of EPS, probably pretty easily, honestly, in 2024. They're not going to have the Rivian problem hitting them anymore in 2024. They're already going to have done all their cuts. So basically this past quarter and this current quarter, Amazon's in right now, including even maybe next quarter. When it comes to these employee cuts, you have a bunch of one-time expenses with that. That's all going to move off for this company in 2024. So nonetheless, when I look at a company like Amazon, I just think this is one of the few opportunities I'll ever get to build a really good sized position on a year like this and make it a very, let's call it, large position in my different portfolios. And so I have to take advantage of this opportunity. Last year, I really took advantage of Meta as an opportunity. I built that into my biggest position in the public account, and that's paying very handsomely, and I think it will pay a lot better even in the future. And so what I saw with Meta last year for big tech, I see this year being Amazon, and this is that opportunity for me. And so I've just been adding Amazon shares, adding them almost every single week. And I just plan to continue to do that, honestly, probably for this entire year. There's no stopping when it comes to this baby, okay? So that's Amazon. Next up here, stock number 2 of these 5 stocks that I am looking to add here in April is Palantir, PLTR. So Palantir, cross sections of data and artificial intelligence, helping governments make better decisions, companies make better decisions. And the interesting thing with Palantir is the stock certainly so far this year has started to come back pretty strong, okay? Very, very strong, actually. Now, I gotta say, ChatGPT might be the best thing for Palantir that's ever happened, okay? And the reason being is this ChatGPT has really put an emphasis and a focus from almost everybody in the business community on artificial intelligence, okay? And I can tell you, like Palantir is so perfectly positioned for this. They've been talking about artificial intelligence and how they basically use your data to make much better decisions for your business or for a government or whatever you need, okay? And so this all falls right into their wheelhouse. This is perfect. I honestly think ChatGPT couldn't have been a more perfect scenario to kind of put artificial intelligence in the forefront in companies to realize, oh man, if only I could use my data a lot better, or if only there was a system that was out there that could sift through all my data and help us as a business make a lot better decisions. Oh, that's Palantir, okay? And so it's absolutely beautiful, and I think this is going to be something that helps Palantir in a massive way for years to go in the future here now at this point in time, okay? Now, when it comes to Palantir, it's been a phenomenal grower. If we go back to this company, 2018, $595 million of revenue. This past year, almost $2 billion of revenue, over $1.9 billion of revenue, right? As far as gross profit, it's insane. $430 million. This past year, almost $1.5 billion of gross profit. And that's on revenue of $1.9 billion, right? It's an incredible number for this company, and that's just one of many reasons why I believe this company is going to build out to an absolute profit machine. Speaking about profit machine, they just are barely getting to infant stage of profitability now at this point in time. So if I think about the next 10 years for Palantir, I see a company that's going to build into a profit machine company and a cash flow machine company here, okay, with amazing margins, some of the best margins you'll be able to find of any company out there from the gross margin side, right? As far as revenue growth, the expectations are not big for this company. I mean, it was expected for 30% revenue growth, but we all know there's been a huge slowdown, obviously, in the economy. And so that is something that is hurts their revenue in the short term. But at the end of the day, 15, 20% revenue growth and a reacceleration of revenue growth next year could be huge for this company. And I love having expectations that are very low. That sets a company up to hopefully come in and beat some numbers. Because if you know Palantir, you know they've missed some quarters before in terms of some quarterly metrics, either on the bottom line or the top line. And so I would love them to be in a position now to actually come in and beat. And obviously, companies that consistently beat numbers, we know what happens with their stock prices, right? Now, in regards to Palantir, it's extremely important. Their cash is insane. I mean, this is about a $17 billion market cap for this company. You're sitting on $2.6 billion of cash, roughly, with no debt. It's extraordinary. But if you know Palantir, and you ever heard about this stock, you probably heard about share dilution and share compensation, all those sorts of things, okay, stock compensation. Well, this is becoming much less of an issue now at this point in time. If you look at their shares issued, it's hardly gone up now at this point in time. And so what that was, it was a huge issue over the last number of years. It's becoming so much of a, let's call it, almost non-existent issue now at this point in time. And so that's something, if that was a big worry for folks, like that's starting to go away now at this point in time. And when I look at a company like Palantir, we're sitting at about a $17 billion market cap for a company that's at the infant stages of profitability, a company that's in with governments like this, that is a game changer when it comes to companies. And I think over this next 5 years, I think almost every single Fortune 500 type company is going to have to consider Palantir. I think this is a company that's going to grow as their customers grow over time, and I think they're going to be in a really good position. And when it comes to Palantir, it's interesting in terms of the stock. I mean, you look at this, right? Today, for instance, 20 million shares traded at Palantir, average volume 41 million. This was a stock that a lot of retail investors were playing around with, traders, and those folks have long gone now at this point in time. And so Palantir now at this point in time, in my opinion, is only attracting like real investors, people like myself. Maybe you're an investor at Palantir, and only attracting like those sorts of folks now at this point in time, which I think is a great thing, because a lot of us are buying this company to hold it for the long term, and we're not looking to get out of the stock or like trade in and out and things like that. And so the volume's starting to die on the stock now at this point in time, and you're only going to get more and more longs get into this. Now, there will be time periods in the future where Palantir is used as a trading vehicle and people are getting in and out and things like that. But as of right now, this is really just building into a long-term investment stock, which I think is a very, very healthy thing, and that's something I look for. And one last thing we'll speak about here before we move on from Palantir is the CEO, Alex Karp, right? You know, I know there's a lot of people that watch the interviews of him, and the thing I see with Alex Karp is I see somebody that is doing a great job running a company. I think in terms of his interviews, I think, especially when he goes on CNBC, they always try to ask him a lot of questions that get him talking more about philosophy and countries and conflicts and all these different subjects rather than talking about the stock and the company. And I think, honestly, he enjoys that more. And so I do think that holds back the stock. I don't think that holds back the company, though. Let's be very clear about that. There's a difference between holding back a stock and holding back a company. And so what I see in Alex Karp is an individual who is not the best person for, let's call it, telling the story about the stock. And I think, you know, we really need the other team members to continue to step up on future conference calls. If Palantir's ever at different investment conferences, even if Palantir is doing CNBC interviews and things like that in the future, I would love to see somebody alongside Alex Karp, where Alex Karp can dive into all the big picture stuff. Well, another executive on the team can dive into more of the company specific things. I think that would be very, very healthy, very, very healthy. So that's what I'm kind of hoping as far as that goes. But my belief in Alex Karp, in Palantir has one of the best employee forces you're going to find of any company in the world. Like, it's, you know, from what I've heard from several people now at this point in time, it's harder to get hired at Palantir than just about any big tech company in the world, literally. It's extraordinary. Like, a lot of people that can get hired at Google and other companies can't even make it past the first round at Palantir over the years. So that's pretty tremendous, okay? So Palantir, second stock up here. Third stock of these 5 stocks up here. This one is Foot Locker. Foot Locker. Simple business model. I mean, if you ever gone to Foot Locker before, and they also own, by the way, obviously Kids Foot Locker, they own Champs, and a few other businesses. If you ever gone into Foot Locker, like, you know what it is but to buy shoes, right? And maybe some clothing, right? We're sitting at about a $3.6 billion market cap on this one right now. Price to sales ratio 0.4, extremely low, but retailers in general trade under a 1 price to sales ratio, so not that crazy, right? As far as the stock price goes, it's up a bit this year, but it's come down recently. A PE ratio of 11 on the stock, a price to book of 1 on this company. I just love this business model, okay? 4% dividend yield, payout ratio under 50% on this one. I love that, okay? And so it's not just about the stock price going up over the coming years, which I think I'm going to get nice capital appreciation on Foot Locker, and I've already gotten a lot of nice capital appreciation, but I'm also believe the dividend is going to get bigger and bigger that's paid out to me. Now, something they talked about on the latest conference call is their relationship with Nike is getting back good again, okay? So basically about a year or two ago, Nike decided to go more in-house with sales, okay? More DTC, direct to consumer. They decided to move away from Foot Locker some. I thought, when I saw that, I said to myself, like, that's a horrible thing for Foot Locker, and it's a horrible thing for Nike. Nike's going to be as strong as it can be, and Foot Locker's going to be as strong as it can be if they're together. And so one of the great things to listen to recently on the latest conference call and presentation by the company is that they're in good with Nike. Again, both sides are committed to expanding the relationship, which honestly, they're both going to do better. If you looked at what Nike's done over the past year and their inventories piled up and their margins got hit bad, I'm just telling you, like, it weakens both companies. They need to, in order to prosper, they got to prosper together, okay? And so I like that the relationship's starting to move back in the right direction, and I think we'll see that play out in the back half of this year and as we go into future years as well. So that's important, okay? You got to have a strong relationship for a company like Foot Locker with Nike. Very, very important, right? Now, they're talking about going from about $8.5 billion of revenues to over $10 billion of revenues for this company. And from about, let's call it 7% EBIT margin and like a little less than, let's say, 10% return on invested capital to low to mid-teens return on invested capital and 10% or greater EBIT margin. So that would be extraordinary. And if you're talking about them going to these sorts of places, I can tell you that net income is going to go up immensely, okay? That earnings per share is going to go up immensely. And guess what? If that goes up immensely, the stock price will follow. And that dividend will be able to be upped quite substantially over the coming years if they can get to where they're getting. And I think they can get there. I see the path on how they get there. And it's not like these are crazy pie in the sky like numbers to like, I can't get how they get there, okay? And they even broke it down here on basically where they were at in 2022 versus where they're going in 2026. About $6 billion, if not more, from Foot Locker business, from about 5.3, from 700 mil from Kids Foot Locker to about $1 billion. Champ Sports is going to be the big decliner. So this is where they're going to be closing a lot of stores and kind of de-emphasizing is Champ Sports, okay? From about 1.7 billion to about $1 billion roughly, okay? WSS is a huge growth opportunity from 600 mil to 1.3 bill is where they see them going over the next few years. Atmos is a little grower there, okay? And that's how they go from 8.5 to, let's call it 9.5 plus or so around 2026, okay? So that's exciting. It's disappointing to see kind of that Champs fall off there. But at the end of the day, they're going to position themselves best for margin growth and net income growth over the coming years, right? They break it down a little further here. This is really for 2023 now at this point in time, okay? They're expecting revenue to be down 3% to about 5% roughly. Comp store sales to be down about the same. Store count to be down 9%, so they're definitely going to cut some stores this year. As far as square footage, down about 4%. Gross margins 30.8% to 31%. Promotional pressure early in the year, so they're going to promote early in the year, okay? And as far as non-GAAP EPS, 335 to 365, which is still a strong number, but obviously expecting a lot more than that in future years. But we can deal with that in the short term here. Now, in terms of 2024 through 2026 for this company, look at this. This is huge for me, okay? For me, this is everything. EPS growth, low to mid-20s, the company's expected, and I can see how they can get there, okay? So what I'm looking at with the Foot Locker is a company that's more focused on really their bottom line and right-sizing this business. And I think this is, the story of Foot Locker here is a story of corporate America and what they've been going through for, I'd say, the past 6 to 12 months and what they're going through over the next 6 to 12 months. Right-sizing businesses, focusing on margins, profitability, net income, EPS, these sorts of things, free cash flow. And I think it hurts short term, but I can tell you this is the healthiest thing long term for business community, for the stock market, for these companies. And so I definitely approve of the moves Foot Locker is making there, and I'm a happy shareholder, and I think I'll be a lot happier shareholder in the future. Alrighty, folks, number 4 up here. This one is not a stock. This is an ETF here, okay? What is it? It is Estelle. Planning on buying some Estelle in the month of April 2023 here, okay? So 3x, it's basically a 3x leverage against the Dow Jones Industrial Average. And this is a hedge for me, essentially. So it's basically a way I can hedge my portfolio. So if the market tanks for any reason, let's say over the next few months, next 3 months, 6 months, 9 months, something like that, I can obviously make money on this and quite a substantial amount of money, especially if the Dow Jones Industrial Average was, let's say, go down in a pretty short amount of time and do it very, very quickly. That would be a pretty immense move. Now, Estelle, in terms of Estelle, it's not always a perfect correlation between a 3x of whatever the Dow Jones Industrial Average. Sometimes it's better than that. Sometimes it's worse than that. It all depends on many various factors, okay, in terms of how that works. No, there's an insane divergence that's basically going on this year between the NASDAQ and the Dow Jones Industrial Average. And the NASDAQ's having a great year, okay? Having a great year this year. Well, the Dow Jones Industrial Average is actually down this year. And this is an interesting divergence, and this is, for anybody that follows my channel knows I called this out essentially at the end of 2022, and I said, like, this is not going to last. There's been a huge divergence between these, and at the end of the day, like, the NASDAQ going to end up way outperforming the Dow, and it's exactly what's happened. And the reason I had so much conviction to make a call like that is what happened last year was so unnatural. There was a huge divergence between the Dow Jones Industrial Average and the NASDAQ. Such an insane amount. I mean, we're talking about over 20 plus percentage points. That never happens. I mean, usually you're looking at a 3 to 7 percentage point difference in divergence between the Dow Jones Industrial Average and the NASDAQ. And so to see a 20 plus percentage, I mean, this was like 25 percentage points at one point. It was so unnatural, folks. That doesn't happen. And so at the end of the day, I looked at it and I said, okay, a lot of Dow stocks have been hiding out money. I think a lot of those stocks are overvalued, and this divergence cannot continue. They're going to start to correlate more in line, and sure enough, that's what's happened here now at this point in time. Okay, now if, let's say hypothetically, the market was to tank, okay, let's say over the next 6 months, okay, everybody freaks out again. Let's say, I don't know, inflation's way stickier than people had thought, and then they're afraid of the Fed, and they're afraid of recession, whatever, okay? So let's just say the market tanks, okay? What I could tell you will happen in that scenario is the NASDAQ will fall, and the NASDAQ will go down to just a slight gainer for the year. But what will happen to the Dow is the Dow will fall 10 to 20%, okay? And it will be negative 10 to 20% on the year. If there was a scenario where the market tanked, let's say over the next 6 months in a hypothetical situation, well, the NASDAQ will still likely be up for the year. Okay, so that's an interesting kind of thing that could happen definitely in the market this year that I see playing out. And so SDAO, a nice hedge for me. You know, do you need to have a hedge on if you're a newer investor to the market? Probably not. I didn't have a hedge on for a long time. At this point in time, my portfolios are obviously, you know, pretty large in size and whatnot, and so I like to hedge a little bit now at this point in time, okay? Especially in uncertain times, like obviously we're going through, and we're going to have to see what happens with the economy and whatnot, just in case, you know, just in case the stuff hits the fan, as they say. What I do with an SDAO, in call options on SDAO and stuff like that, is if we had any sort of major tank in the market, whenever that would be transpiring, that's when I'd be looking to basically reposition out of those, take profits on those, and then reposition into longs at that point in time. And then I would go ahead and basically re-hedge at the very end of this year, essentially. So let's say hypothetically over the summer, market's tanking, it's getting ugly, okay? At that point in time, I go ahead and take all those profits, go ahead and funnel it into long positions at likely very low prices, let's say, right in the summertime or in the fall time or something like that, and then go ahead and re-hedge. Doesn't mean I'll re-hedge back into SDAO. It could be something different at that point in time, but that would be at the end of the year at that point in time if I was to do something like that, okay? And so just to kind of run you through my thought process on how all that works, okay? Alrighty, so that's SDAO up there. Number 5, this is a pretty simple one here, folks. This one is not too complicated. It is Walgreens Boots Alliance, WBA on this one. This one is actually down this year about, let's say, 6% or so, sitting at about a $30 billion market cap on WBA, okay? Not a super complicated one. It's a dirt cheap company. I know the company very well. I used to work for Walgreens many years ago, okay? I worked for Walgreens for probably, oh gosh, what was that, 2.5 years or so. Walgreens, 6% dividend yield in this one, forward P of under 8. It's a dirt cheap company. I mean, insanely dirt cheap. They have their full year EPS, they're doing full year EPS guidance of 445 to 465. So, I mean, when I look at this business, I just see a stable, great company that is going to throw off insane cash flow, insane net income, and be able to pay out huge dividends, and in future years, hopefully even up the dividends bigger than what I'm getting right now. So let's say let's say right now I'm buying the stock, right? I'm getting a 6% yield. Well, if they up that dividend and continue to up that dividend over the next few years, you got to understand the yield I'll be getting on the shares I bought could end up being 8% yield, 10% yield, 12% yield, okay? Paid out to me each and every year. That's a beautiful thing. Now, obviously, if they do a bad job running their business, they could cut the dividend and the dividend could get smaller. That's certainly a scenario. That's not the scenario I believe is going to happen with this company. I believe they're actually going to expand their net income quite substantially over this next few years and be in a better position to continue to up that dividend more and more and more. And so I'm getting a 6% yield now, which is sweet, but I could be getting an 8%, 10%, 12% whatever, 14% yield in the future. Remember, there's shares that Warren Buffett bought at Coca-Cola, decades ago, that I think he's getting something like an 80% or 100% dividend yield on now, because he bought those shares so low, and based upon the price, Coca-Cola pays out in terms of dividends nowadays, it's insane. And so just do keep in mind, like, when you own stocks for years and years and they keep up in that dividend, like, the yield you're getting on your shares are actually exponentially more. Okay. And when I look at the management team led by obviously Ross Brewer, like, I sleep well at night. Let's just put it that way. I have no, I listen to that conference call and I'm just like, they're in charge. They got that show on lockdown, and I don't have to worry about that one. There's other companies I own that I definitely have to worry about and stress over. Walgreens is not one of those companies. And, I know they got canceled on Twitter about a couple weeks ago. I mean, I don't even remember them even talking about that on the conference call. It's just such a non-issue. So anyways, really good position there. I appreciate everybody joining me as always. Hope you got good value out of this one. Those are the positions I'm looking to buy. Those might not be the only stocks I buy. I might definitely make some other moves out there. And if you want to keep track of all the moves and you want to support my content, you want to support the channel, check out my Patreon in the description. If you have ambition to scale to 6 figures, 7 figures plus in your portfolios, and you want to learn everything that I know up here and I've learned over the past 15 years, then apply to join my private stock group. That will be the pinned comment down there. I appreciate everybody joining me as always. Much love and have a great day.